Questions first. Let's open up with questions. That's a lot of information on insurance. Insurance is a lot. I mean,
I have one about like the health insurance.
yes.
Um, so with the health insurance, he's talking about like the health savings account.
HSA. Yeah.
So like my job does HSA, but it's also you have to buy another policy. So if we just get the HSA life stuff.
So HSA is connected with the policy.
Okay.
So it should be
The
joined.
policy, yeah,
So like whatever policy you get should have an HSA option.
Yeah.
And if it does have that option, like in your scenario, how often are you actually really going to the hospital or to a doctor? Never. So you might be perfect for it because it'll allow you to stack up money inside the HSA eventually. And then when you actually need it, your deductible will be right there in the HSA. And when you don't need it, you just keep rolling it over to next year and making more money with it. HSAs are also investable. You can invest that money as well. And I'll show that in the future. Yeah.
So I should buy it.
Yeah, if you have if you can have an HSA policy, it's actually one of the best. Only if you fit that category. So either you're super always sick, and just always in the hospital, and that's weird to say, but
Yeah.
if you're always in the hospital, it's actually one of the best plans too, because you're gonna look at your deductible, and then they're gonna take over 100%. Or if you never go, because then you're gonna have a very low deductible, a very low monthly premium, and you're gonna be building up a savings, a medical savings account, like I said, which you can invest. You can also pull that money out when you check it down the half, so it's kind of like a long-term investment plan as well. Or if you start to get sick later on, you have that money sitting there and you can start using it.
How much do you recommend putting in each month for? Like,
So that's individual based. I'd have to look at numbers to give you a real answer on that. But currently speaking, if you're in baby step 2, 0.
0?
Yeah. Because I want all the money that you can possibly make outside of taking care of your regular bills to go towards getting out of debt first. Get out of debt and you're healthy right now.
Yeah.
So we already know that. So let's get out of debt as fast as possible. Then we'll get into the next realm of, hey, how do we get more money saved up in different avenues?
Okay.
Yes, sir.
For the money for debt on baby step number 2, you pay all your bills completely first, and whatever money you have left over just goes completely to debt.
Correct.
And you start with the smallest one first.
Yeah. So if you haven't done your debt snowball, make sure that you do your debt snowball. I did right here when we first started, but you should be listing your debts from smallest to largest,
Okay.
and then attack them in that order.
Okay.
Anything that you make extra, if you have an extra business, if you have extra side hustle money, if you get a little extra money in your paycheck, if you take care of all your bills and you check those off, you should be putting it in towards the debt. There's also in your budget, which we didn't kind of go over yet, but in your budget, you should be cutting things in your budget to get to paying more debt into your debt. So if you can cut back on food, eating out,
Gas,
hair,
subscription.
cosmetic, subscriptions.
Okay.
I missed anything? That's it, cosmetics.
Yeah.
Oh dang.
Get your hair done, get a haircut.
Yeah, I cut that cost too. I think I'm
Yeah.
gonna go to Jordan instead because
There you go.
it's 50 instead of 15.
There you go. Way better.
Yeah, way better.
And clothing. Clothing.
Oh,
Yes, ma'am.
So I missed like auto insurance, but I did fill in the blanks. Could you just touch base again on the auto insurance policy more so like?
So auto insurance, there's collision is actually that biggest one to talk about. So a lot of people, you can either have collision or take it away from yourself. It's actually one of the biggest things you can take out of the policy. So if you have a car, I don't know why you call it the Ramsey cars, but it's truly if you have a bucket car. That's actually a better name for it. A bucket car, and you know, hey, this car cost me $2,000. You don't really want to have collision on a $2,000 car. If you wreck the car, you can just go buy another $2,000 car. Because that's what collision is protecting, like when you're at fault. If someone wrecks into your car, that's liability. They're liable for that. So you don't have to worry about that. Their insurance covers your. It's more so when you wreck your car. Like if you get something, you run into a wall, you hit the car, like that's when collision kicks in. Like I said, but that's just to replace your car or fix your car. It has nothing to do with their car. So liability will cover that. For if you hit somebody else, then your liability part of the policy will kick in. So you can eliminate collision or you can keep it, but you can also take your deductibles up too. So which would decrease your premium. So if you say, hey, if I got into an accident, instead of paying 500 or 250, I'd rather pay 1,000 or 2,000 or 5,000 out of pocket. Of course, 5,000 would mean you have a car that's worth a lot of money. So if it does get into a wreck, 5,000 is nothing compared to what the car's going to cost to get fixed. So those are the things that you kind of have to play with in the auto insurance side of things. The top insurances though that you guys should have, anybody remember what they were? Yes, it's your cheat sheets.
What was it? I'm sorry.
Top insurances that you guys need to have, that you must have.
Collision, comprehensive, and liability.
Top insurances, total insurance.
Oh,
Auto is one of them if you're naming all the different parts of auto.
Identity
homeowners
theft.
and renters.
Identity, homeowners and renters,
Umbrella policy.
umbrella if needed, yes.
Life insurance.
Huh?
Life insurance.
Life insurance, what kind of life insurance?
Terms,
Why?
because whole life is not good,
Why?
because it's a scam.
Why?
Because God said.
Yeah.
Why would you say offense and defense?
Yeah, well, because of, well, defense, because of, something happens.
But what's the offensive side of term versus whole life?
You can put in savings.
Yes, you can invest that money. So like, you can actually play offense when you have term insurance. You can't play offense when you have whole life because it's pulling from it and it's investing horribly. Like, as I said in the beginning of this class, and I am a broker, I'm a licensed broker. I had a client who is still gets coached by me, uses me for tax preparation, will not use me for life insurance because she has a whole life insurance policy and she does not believe in term insurance. And no matter how many times I've broken down the numbers, she trusts me like everything else, but her mom has trained her that whole is the best, so she's gonna go with her mom on that one. It sucks for her, cool, listen to your mom, but you're literally throwing hundreds and thousands of dollars in the long term away. And so, and I'll state this because I've actually showed people my numbers. The way a broker gets paid on term insurance, there is absolutely zero reason for a broker to push term insurance. Because you make no money on term insurance, literally. And if you literally you can ask anybody who's ever sold life insurance that they've been a broker and they've done it. Like, let's just say a policy, I get him a policy, right? That policy, if it's $25, I'm gonna get 85% of his $25 for 1 year, then I don't get paid again.
Yes.
But if I had a whole life policy, I'll get the same percentage, but I'll get paid forever with that policy.
Residual.
So, which one seems like a broker would push? The whole life. So if a broker's coming to you and they're pushing term, they literally have the best interest of you at heart than they do themselves. Because they are not making it, unless they do add-ons. Now, we put any add-ons in the insurance world, that's what Dave was telling you guys, stay away from. I don't push any add-ons. Waiver, premium, I don't do any of that stuff. But I'm saying, like, in most insurance people that I know that are pushing term, they don't do any of that stuff. So they really just have that's why you'll actually meet, if you have an asset manager that you ever meet, a lot of them don't even sell, and they have to be licensed to sell life insurance. They won't sell it to you because it's a waste of their time. Like, why would I sell you? I need to get your assets over to me so I can make you money, so that I can make money. So they won't even sell you life insurance at all. And I know that because I have a team that I work with who are asset managers, and they will take my clients and they will invest with them, and they'll send them to me to do their life insurance policies. Because they know, like, I know he'll do it because he doesn't care about it. He'll write you a good policy. They just don't want to waste time with it, period. So, because there's no money involved when you're writing term insurance policies. So, that should also tell you that that has the greater interest for you as a person, the consumer of life insurance. You should already know if that's the case, then term is the only way to go. Because term is to benefit you, and it's for a term. Now, what is the benefit of having term over a whole life besides just the dollar factor there? Anybody know? what's the benefit of having term over whole life besides just the dollar factor? So we know that we're gonna be able to invest the difference. What's another benefit of having term over whole life though?
Does it overlap?
Bless you.
You have a higher outcome of money in the end, right?
We got that part, but I'm talking, what's another actual, well,
Oh,
explain your statement.
Well, at age 70, like in this example, a whole life policy would be $65,000.
Yeah,
And then the 20-year term policy with 500,000 in coverage, you're gonna have 1.3.
so you're going with the investing side of it. So that's the first part we talked about. There's another part to this stuff that's more important than that. Well, I won't say more important, but just as important. So you guys look stuffed on this one. Okay, so in a term insurance policy, you get a $500,000 policy, right? In a whole life insurance policy, you can make the exact same amount, supposedly here, right? The massive difference is, if you have a cash value in a whole life insurance policy, let's say it's $120,000 in there, right? But your whole life policy is also written out for $500,000. You only get the $500,000. What happens to the $120,000 cash?
no.
Oh.
It's gone.
It's gone.
So you lost all that money anyway.
Oh.
I don't know if you
So
guys
you have
knew
to take
that.
that money out?
Well, you can't because it's locked in your policy unless you do a loan against the policy, and then they would minus that out of your actual policy if you died. So the way whole life works, the only way to get that money is you have to make it to 99, or whatever the contract whole life policy is. Normally it's 99. You make it to 99 years old, you get to pull out all that cash. You can pull out at retirement age as well. So there's other tricks you can do, but I'm talking about like if you're just pulling the policy out, then yeah, you need to be 99. Once you're 99, you can pull out the 120,000, and you pretty much get back, or maybe whatever amount that it occurred to at that time frame.
You're paying that 120,000 over.
It could be more
increments.
than 120,000. I'm just using 120,000 as a flat number.
That's being paid over increments to cover for the.
So like basically, the way it happens is you're paying into your, so let's take a term policy at 500,000 at a good age, it's like $30 a month, right? And for the whole life policy, for the exact same policy, you're gonna put another $100 to $200 in that policy for the cash. You understand? So now you're paying like $250, $230, whatever it's gonna be, $130, let's call it $130. That extra $100 is going to what's called the cash value system. That cash value system, as it occurs, right? If you were to die in that time frame, if your policy was written out for 500,000, they're only gonna pay you on the 500,000, whatever the higher number is. So the cash that you get, so let's say 30,000 in there, there's 30,000 cash in there, you'll never receive it.
And that was the 30,000 paid over the months.
Yeah, correct. That's the extra payment that you've been
Oh,
paying
that's
the entire
crazy.
time. You don't get that money back because it doesn't work for that. The policy's only written out to give you the higher number.
But in the term policy one, whatever money you're putting in, you can get that.
But
back.
term is only, it's the set. So think about that 100,
Yeah.
minus out the 100, and it's $30, right?
Yeah.
Those same $30 is the term. So you're only buying, even in a whole life insurance policy, you're still buying the term. They're just giving you the cash savings, the benefit to it.
So what makes it sound so appealing that, because like the way you
Cash.
just,
Cash.
cash.
So this is the way it sounds bad, okay?
Yeah.
I'll try to make it sound bad because it
Sure.
doesn't sound bad in my head. But I'm gonna give you a policy in 20 years, you're gonna pay $30 a month for 20 years. And if you don't die, you don't get no money. But if you do a whole life policy for the exact same time frame, in 30 years, if you don't die, then you get the cash that you saved the entire time frame.
But you don't
That's
get the
how-
money that you,
No, you didn't die. So if you didn't die, you don't get the value of the policy, but you still get all the cash you saved. So then, hey, if I save, $40,000 in 30 years, I get the $40,000. You made money. But that's how whole life works, though. Like that's the trickery of whole life. Is to make you think if I save $100 extra, so I'm putting $130 in this policy, I'm gonna get that $100 back at the end. If I go to term life insurance, I'm gonna pay $30 every single month, and in 30 years, if I haven't passed away, I get nothing from that, which is correct. It's a term policy. The whole policy has the exact same term in there, so that extra 30 you were paying, you get nothing from that. But the extra 100 that you were saving, you get the cash value that's in there. That comes back into your pocket, and you feel like you accomplished something. That's how they sell it.
For the whole life, what point do you have to like, that you cannot pay that policy off? Cause it's like, at a certain point, you don't have to pay it, cause it just already makes money for you. basically.
Depends on what type of whole life you get. So there are different policies. Not all written that way. Some are written that you're gonna pay into that thing forever. Some of them are written to 65. Some are written to a lot of them stop at 85. I think it's like the max 85 years old. You'll pay all the way up to 85 and then you won't pay no more. I think that's all policies for whole life, no matter what kind you get. There are pay up front whole life policies. There's IULs, ULIs. There's a ton of different policies. They're all are whole life with additional benefits. Like there's some that you can do a lot of investing in, where you can actually invest in a whole life policy. So now you're actually playing the stock market inside the whole life policy. And the way they teach it to you is there's so much more benefits because you're secure. They're trying to put a blanket over a blanket. The thing is though, when you run the numbers out, in the next lesson you guys are gonna see that, when you run the numbers out, no matter how you flip it, who's all in the 20s? 20, 20, 20, 20. When you run $100 out over 20 on any long-term term policy, 30 years plus, just $100, it's $1 million. Over the same 30-year term policy, it's $1 million. So I don't see why you all of a sudden would take that money and put it into a policy that's never gonna get to $1 million. But in the way it's written is that you're gonna be safe because if the market goes down and the market does this, you're still guaranteed some type of return in whole life policies.
But the concept of life insurance is mainly just if you die and then your spouse gets money, right?
It's the term part. So that's why I'm saying like both policies have term in them. One is just purely term. The other one is a whole life cash value with the term in it. The whole point of life insurance is the term. Like that's all you want whole life. You do not want to invest in a life insurance policy as your main retirement goal. Because when you get to retirement age and you didn't die and you realize you only saved up $40,000 on this year, you're gonna be mad. Like this wasn't worth it. Like I'm gonna live off $40,000. I'm gonna take $400 a year. Like, I mean, even if you're debt free, you ain't living off 40 grand. So.
Another question.
Yes, ma'am.
You said to find yourself an insurance broker. Where is a good place to find those? Well, I knew that, but I'm just saying for other people.
Every single field has an insurance broker, by the way. If you go into home insurance or renter's insurance, you want a broker. And what that means is you don't want to go to State Farm. You want to go to somebody who shops State Farm, Progressive, all the other ones, Farmers Insurance. They shop all of those because there's no bias with them. When you shop at State Farm is only selling you State Farm's insurance. And I will say State Farm is probably like one of the best out there. But even them being the best doesn't mean that they're the cheapest though. It doesn't mean that they also hold up to their policies. All these insurance companies, by the way, and I just want to make this very clear. I haven't ran into one, so I'm gonna say all. All these insurance companies are going to fight you when it's time for them to pay.
Yep.
Like they're all gonna do it. So if someone tells you, no, this one's way better because they've never, no, that's a lie. There's not one out there. Dave had to find this out the hard way because he used to be a big fan of State Farm too, and State Farm will fight you as well. They don't want to pay because they always want to find a loophole not to pay. So that's just the way it works.
Are you gonna charge me for these?
Huh?
Are you gonna charge me for these?
Am I gonna charge you?
If I use you?
No. But I still make money no matter what on the first year of the policy. Like you pay the policy like a regular policy, and I still make money on the first year of the policy.
So I have a cash value one, so we're gonna have to go through and cancel.
Oh
it.
yes,
And
we don't
then
do cash value.
we'll-
We don't do that.
We don't do that here. She sold insurance too before. So in case y'all want to verify anything, you can ask away.
All the research I've done, just invest your money in a good, investment vehicle and just get term. Because you'll get more money in the end. IULs are just crap.
So it's an insurance game, unfortunately. But you don't find that many insurance companies now or insurance brokers that push that anymore because it's too much information out there. You can just literally Google it out and everybody's like, yeah, this is the worst thing for you.
Yeah.
So the way that they do it now, a lot of the stuff is pushed now is to wealthier people. They push this to evade taxes. So there are tricks and stuff that you can use with insurance to evade taxes. But you in order to get in that game, you're talking about a total different game. And you need a lot more money to do it. So for the average person, term insurance is where you want to be. And even when you're wealthy, I still think term is the way you want which way you want to be. Here's the thing though, insurance term is temporary. It's only to cover what you can't cover right now. So right now, unless you're a multi-millionaire or a millionaire or whatever, that's the reason why you're getting the policy. Once you hit $1 million, then you're gonna get to sit down and have a different discussion now. Like, hey, do we need this term policy anymore? We got $2 million in the bank, and even if this, and this happen, we're gonna be good. Let's go with 2 million. That's the number I just said. If you have $2 million in the bank and you lived off of 10% every year, how much income do you have? Say again?
200,000?
200,000. Okay. If you live off of half of that, you live off 5%. You got what? So if you got no debt, house is paid off, and you live off 100K, are you good?
Yes.
So if you passed away and you got that, remember, it's gonna, let's just say it makes 10%, you live off 5%, you're still gaining every year. You're in a better boat than like 99% of America. So at that point, you might just say, hey, I don't need this insurance at all anymore. I'm done with the insurance. And now you're not paying $30 a month. Now, could you keep it? Yeah. Because now you got $3 million. Because you got an extra coverage of $1 million if you pass away, and you got the $2 million. So, it could work out your benefit as well. Okay, so.
Wait, so where does the money come from? So if you're paying $30 a month and they're covering like it's a $500,000 like term or whatever the value is of, let's talk about the term concept. Where does the money come from?
That's a great question. So it's over a bulkhead of different things. Okay, you gotta think about it. If you got, I forget how many billions of people are in the world, you don't even need all of them. Just do 100,000, right? 100,000 people. Anybody got a calculator? Want to do this real quick?
Yeah.
Is this part of taxes?
Watch this. No. So 100,000 times by $30. 30.
3 million.
How much is that?
3 million.
So times that by 12.
36.
Now add that plus 10%.
Plus 10%.
Plus 10%.
I see. Numbers.
Yeah.
Mm.
Huh? I don't know what the million was. It should be like 360,000. If it was 2.6 million. Say it again.
If everybody's just paying
So if you had 100,000 people paying $30 a month, and then the insurance company is gonna take that money, right? And they're gonna hold that and they're gonna invest it. And if they invest in 10% in 1 year's time frame, that same money just turned into
39,600,000.
39,600,000.
Now, is that a capitalist thing? Are we able to do that, like, because everybody's helping each
Because
other?
everybody
out?
helps now.
Yeah, or is that like a whole world thing?
That's just how insurance works.
That's how insurance works.
That's how insurance
That's the concept.
So the concept is, the way insurance is beneficial is because they know if she invests with me $30 a month, she's not gonna die the next year. So they're banking on that. They're banking, if we get 100,000 people at her age investing, well, sure, we'll keep it low. She'll pay $25, $30 for this policy that's gonna cover $1 million for her because she's not going to die next year.
And then companies took that and then put it into different assets, like
Correct. So
vehicle insurance,
they have other vehicles that they use
home.
to make money with that money, and then that money they can now say, hey, look, this money's making this money for good.
Oh, so people now there's a different level where people are in the game taking the money that
Okay.
they take from that big pot and they start investing the money.
So that's what the insurance company does. The insurance company is going to invest that money as well because they got to make money off their money.
Okay.
So they take that money, they probably won't invest all of it. I'm just giving you a full-on example of it. But they're going to invest that money, and that money is also going to keep their companies making money. Therefore, because there is going to be that 30-year-old who dies from a car crash.
Sure.
Or might have a heart attack out of nowhere or something. So we can't predict those things.
Sure.
But that 1 million that comes out, or 2 million, or 12 million that they lose for the year, they covered their butts on the other hand, and they've invested it to make that money back as well.
Oh, so there's some banking stuff going on.
So yeah,
Finance.
They do a lot of financings, and then but they have they know different assets they need to buy and cover just to make sure they cover themselves too. But like I said, just doing the math on just 30 times 100,000 covers them as well, because those 30-year-olds aren't going to die. Now, of course, now think about it. If a 50-year-old goes to get a policy, it's going to be a lot more expensive for him to get a policy because they predict his lifespan.
Based off morality.
Correct. So they do a lot of studies on this stuff. So they know, hey, if I put a 25-year-old in insurance, he has a longer lifespan to live. If he gets a 30-year policy, we're covered. We're good. He's not going to die for probably wouldn't die for that first term, that first 30-year term.
So you find a couple thousand 25-year-olds like that.
Exactly. And there's plenty of them.
There's a lot of them.
So if you can cover all of them, you're covering your bases. Now, if somebody goes and they're 50 years old, you're not scared to give them a policy at all, because you got all these younger folks that are going to live anyway. You're going to cover the 50-year-old, even though you're going to charge them a higher premium, you're still going to cover them.
What's a
Therefore, premium is what you pay every month.
Okay.
That's whatever you're paying every month.
Like the subscription.
Yeah, correct. Yeah.
Okay. Cool.
How do you know where to invest that extra money or to like say like so like I have a whole life obviously.
Mm-hmm.
But obviously now I don't want to. Can I take the money out to invest myself
You should.
instead?
Yes.
Yeah.
And in your case right now, you might end up taking the money out and paying it on debt. And then after that, the extra money that you're paying, is that the yearly one? You pay yearly, or you pay monthly?
Yearly.
Okay, so you would take that yearly amount and just send it towards debt for now. And then once you're out of debt,
Right there.
then we would talk about how to invest that.
Okay, thank you.
No problem, see you guys.
You just have to do it the right way.
We do need to too.
I know, we don't.
You're still-
We didn't need to discussion of that.
Yeah, so it's cool.
Any other questions?
No, I'll probably have more later, but it was a lot today.
This was good.
Was Chinese to me.
It was Chinese.
Wait, what happened?
I don't get
Recommend getting a will, like he says,
100%.
right now when I have nothing.
You have plenty of those. You have a insurance policy already.
Well, I gave that already to Ava.
Okay. And you can still write in your will what you want her to do with it. You can give her some guidance.
Isn't like a will like for sure that a couple thousand to just even get started?
No. A will's cheaper than that. It's like $600, $700 to get a will.
Oh, really? That's-
Yeah, I don't even know if it's, there's a few of them that you can just do online, there's like real small wills, but it'll lock in, like legally document that you have a will. You don't have to pay that, but I mean, you're thinking about estate planning. Estate planning and will planning, you do need estate planning once you start to make some money and save up some money, then that's the next step to after a will. A will, you can do a will for a couple $100 and then you'll just have a will done. And therefore, if you die, everything in your will be set. And of course, once you have one in place, you can always update the will. And now I bought a house, now I want to update that will, so
You said it's like $600-700?
I think so.
So I'm budgeting to get that?
You should probably stack some money away just to have it. What you could also do is do what I have done, like I just wrote out a will. It's not a legal documented will, because I need to do estate planning. So, but when I first got started, it was just, I wrote out a will. I mean, at least it's something. You can write that out right now while you're still in debt, but you can find cheap ones online. I mean, it used to be like $25
But
for a
again,
will.
like, but in what would that actually, like say I, God forbid, like I did pass away, I wrote down a piece of paper.
And you wrote it, take a copy of driver's license and sign on that thing, You could even take it down to a notary for like $20 and get them to notarize it. And now it's an official
Now
document.
it's official, okay.
Yeah.
I was gonna say, do you have to get it like notarized? 'Cause
Yeah, you could do
me
that.
writing it out really doesn't have
I
anything.
mean, as long as you type it up and go down to a notary and hey, we're gonna notarize this and then laminate that thing afterwards, boom, you got yourself a legal document now.
Yeah,
a
okay.
picture frame.
That's what I'm saying, like,
I'm gonna be
this is my
notarized.
will.